One of the biggest benefits in owning real estate in Canada is that there is no capital gains tax on your primary residence. For properties that aren't your primary residence, pre-tax and post-tax gains can make a big difference depending on your personal income tax brackets because capital gains tax can be pretty hefty. So, what's actually a better use of money? In this video, I'll compare two options. One, putting your money in a rental property, and two, putting your money in a principal residence instead. And after the comparison, I'll reveal what makes more financial sense. Please give this video a thumbs up if you like this content, and don't forget to subscribe to our channel to see more videos like this made specifically for real estate investors in Toronto. Before I dive into things, I want to mention that this analysis is not financial advice and you should always check with your accountant to verify how it's done for your particular situation. Now, let's go over a quick recap of total return calculations. On a principal residence, you don't have rental income, so all of your housing expenses need to come out of pocket like utilities, property tax, and mortgage payments. The important thing here is that the bigger the property, the bigger your monthly payments tend to be, so you need to make sure you can comfortably pay for all of it from month to month. And these bigger outgoing expenses will lower your total returns on your primary residence. On the other hand, capital gains here are tax-free, which is your biggest benefit in this case. Now, here is a simplified formula for calculating total returns on a primary residence. Because different properties might have different prices, let's look at things as a percentage of the property's price on an annual basis so that things can be compared apple to apple. On a rental property, the rent you get will pay for a big portion of your outgoing cash flows, if not all of it. The net rent after all expenses are taxed as income based on your personal tax bracket. Practically, accountants might take into account capital cost allowance, essentially depreciation expense, to defer your rental income to the time of sale. But in this video, I'm going to keep things simple and not take that into account. On top of that, I'm going to make another assumption that you are in the highest tax bracket at around 50%, so half of your rental income is given away to tax. To make sense of all of this, just know that if you do use CCA or if you do have a lower tax rate, that just means that your rental property scenario might be even more attractive for you. Now we'll move on to the capital gains tax on your rental property. Capital gains are big, and if you're holding real estate for the long haul, that probably means that you're going to be in the highest tax bracket when you sell. Half of the capital gains are taxed, so basically, your capital gains are subject to roughly around 25% tax. And here is a simplified formula that I'll use to calculate rental property returns, and I'll look at things as a percentage of the property's price on an annual basis as well. So now that we have formulas for both options, we can use some more math to get the break-even point between the two options. Now, if you look at the formula, leverage cancels out on both sides, and after you move things around a bit more using high school math, here is what we're left with. Now, this can be a bit abstract, so I'll explain what it all means in regular person terms. Basically, if appreciation is more than 2 times your rent plus expenses, remember everything is calculated as a percentage of the property value, then putting your money in a primary residence will give you higher returns. When that's not the case, then it would be better to put your money into a rental property instead. So let's see how this formula applies to Toronto freeholds right now. Gross rents are around 5% of the property's value. Operating expenses before interest is around 1%. And if you get an interest rate of 2% on your mortgage and you have 80% of your property mortgaged, then that just means that your total loan rate is 1.6% of your property's total value. So in this case, the break-even appreciation rate is 15%. In other words, if annual appreciation is over 15%, then putting your money in your principal residence is better. If annual appreciation is less than 15% per year, then a rental is better. Now, last year was a bit wonky with many properties in the suburbs getting over 20% in annual appreciation. So putting all your money in a principal residence in the suburbs was actually a better choice last year. But if we zoom out, you have to understand that 20% per year in annual appreciation is not normal. On a long-term basis, we're looking at around 7 to 8% in annual appreciation in the GTA over the past 20 years. So from a long-term investment perspective, putting money in a rental property typically gives you better returns overall. I did a bit of a sensitivity analysis, and here is a chart that shows how returns vary based on varying appreciation rates. As you can see, the break even where total returns start looking better on a principal residence is when the appreciation rate goes over 15% per year, which is pretty atypical. Now at 7% appreciation per year, we're looking at 27% annual total returns on a rental property and 18% per year in total returns on a primary residence. So the rental property is a better investment. Now, if you're solely making decisions based on numbers, then it might make more sense to put all of your money in investment properties. But we're talking about homes at the end of the day, so there definitely are qualitative aspects, meaning a better quality of life will give your primary residence bonus points. Now, taking that one step further, this comparison also doesn't take into account the extra cost of living when you're putting all of your money in rental properties. I didn't factor this in because some people might be able to live at home for free, whereas others might be okay with sharing a home with other tenants, while some others might want a more luxurious home in a great neighborhood with better schools. So definitely factor this into account when you're doing a comparison based on your unique scenario as well. At the end of the day, most people typically strike a middle ground and put some money into a principal residence so that you can live a comfortable quality of life, and then putting the excess in rental properties. If you get anything out of this video, just know that putting money in Toronto real estate gives you great returns regardless, as long as you can make the higher monthly payments of home ownership in a principal residence. Even though principal residences do have lower returns, 18% annual returns on a principal residence after tax is an amazing use of money. Okay, so this video was a bit more advanced compared to my regular content. So if you stuck with me until the end, thank you. And if you like content like this, please let me know in the comments below, and let me know what other things you want me to do a real estate financial comparison for as well. If you need help getting into real estate investing in Toronto, we're happy to help. If you're already a real estate investor, but you want to work with an advanced brokerage that really knows the ins and outs of real estate investing, we're here for you as well. You can reach out to us by heading to the link I'll put in the description below. Don't forget to give this video a thumbs up, and for more frequent updates about real estate investing in Toronto, look for us on Facebook, Instagram, or LinkedIn. I wish you all the best in your real estate investing journey. Thanks so much for watching, and I'll see you in the next video. Bye-bye.